Super. Well, hi, everybody. It's Narelle Glynn from Hunter Advocates. And today I am delighted to be joined by Dave Henderson from AQUA Financial Services. Dave's a lending manager, and I've invited him along to help unpack a little bit about what a lending manager or a broker does and how they help buyers to secure the right lending product for them. So welcome, Dave, and a special thanks because it's actually the eve of grand final public holiday. So serious dedication to be with me today. Very, very grateful. So in a nutshell, can you just tell me what a lending manager or mortgage broker does?
Sure. So look, the main thing, Narelle, I suppose, the way in which I see the role, it's really about assisting clients and helping them to find solutions that are fit for purpose and fit for their needs. So it's around, I guess, kind of guiding and educating clients in terms of what sort of product choice they have access to and what sort of lender choice. And really with the environment we're in today, the key, I guess, is really helping them kind of navigate that, because there are literally, from a mortgage sense, there's literally thousands of products to pick from and 20, 30, 40, 50 lenders. And it's really about kind of gathering up the client's information, getting an understanding of their circumstances, and then coming back to them with recommendations to say, guys, this is what's going to, I guess, suit you best or work best for you and give them the best experience through that sort of home buying process or refinancing process, if you will.
Fantastic. And what are borrowers experiencing at the moment? What's happening in the broker world in terms of lead time changes to, credit lending policy? What's going on that you could share with them?
So look, I think probably the big one is around turnaround time. So if we were having this discussion 12 months ago, I'd be saying to you, we lodge the application today and we'll hear back in about 6 to 8 weeks, depending on which bank it was. The banks have actually done a pretty good job at bringing all of that back now. So a big thing now is you lodge applications now, turnaround times are down to a week, maybe 2 weeks at worst. So that's a really, really good
Wow,
sort of
that's
outcome.
great.
The other thing we're probably seeing is a lot more digitization. So where our roles were very much about going out and meeting people in person, COVID has really sped up the process towards kind of digitization. So there's a lot more stuff that we can do online now, whether it's having meetings with clients, running their identification or all these kinds of things, banks are now slowly moving towards DocuSign. So all of these sort of features didn't exist 2 years ago. And we're very much sort of moving towards that, which does help speed up things like processing times and just efficiency in general across the market. So we're seeing a bit of that on the one hand. On the other hand, in terms of the challenges, I suppose, if you will, from a client's point of view, is there are a lot of changes going on in the lending space with lender policy. So you're finding a lot of changes, particularly around how lenders treat and view living expenses. That's a big kind of topic of contention at the moment, and a lot of lenders are tweaking what they do in that space. You've got other lenders tweaking what they do in terms of what we call debt-to-income ratios or loan-to-income ratios and things like that. So all of these kind of factors, I suppose, they're playing out over time, and they will continue to evolve over the next, I suppose, 6 to 12 months. And we'll just sort of have to see how the environment plays out. But there are lots of changes happening. It's a constantly changing environment.
It sure is. And I'm a bit excited that maybe that huge mortgage packet that used to turn up and with the little tabs of sign here might be converted to
Look, most of that's gone now, to be honest. But you've banks that are a bit slow to catch up, but a lot of banks, it's almost end-to-end digital. So you can sign everything from your first application form through to loan docs, mortgages, things like that. And look, the banks are catching up. So, they're not all there. It's not the smoothest process in the world, but it's certainly getting there. So we're certainly making progress.
Love it. And so far as the forensic nature of that, delving into your spending history, how far back are banks going, Dave?
Generally speaking, they'll go about 3 months back. But again, there's some developments in that space too, where the banks are now using something called CCR, which is, I think it's comprehensive consumer or comprehensive credit reporting. So really what's happening is there's a lot more sharing of information going on between banks now. So if you've got a credit card that was in arrears 19 months ago, for 3 months, a lot of banks are going to be able to see that information now.
Mm.
And that can potentially affect the stat, how your application is viewed and perceived. So again, it's very much about that sort of changing environment. So not everyone's doing that now, but it is definitely moving in that direction where people need to be aware that their history can affect their future in a sense. And they really do need to be on top of their stuff, on top of their financials, because the banks are very much about looking at conduct. So
Mm.
although realistically some banks look 1 month, anywhere from 1 month to about 3 months, but because of this new sort of information sharing stuff that's going on, that's definitely going to create some changes and create some friction and stuff. And I've seen that with examples of my own clients where you run some scenarios and you run a credit file or something, and you're like, okay, well, I can't take you to bank X because 18 months ago you were 2 months behind on a personal loan, and that's just going to kill it for you at that bank.
Mhm.
So they're going to see it in the background. So there's a lot of that type of stuff going on now. So
So
again, a lot of this is
really,
also.
it just varies so much between lenders, doesn't it? And that's really, to me, where a strategic lending manager really comes into their own, because when they go into that effort of understanding your circumstances and your history, then they'll save you so much time in getting you to the right product more quickly.
Absolutely. So a lot of it too, and lender appetite, I suppose you'd say, changes over time with this type of stuff. So banks do evolve how they look at these things, and a lot of it depends on the credit assessor you get on the day. So you were talking about forensic examination of expenses. I've seen some absolutely crazy stuff go on in my day. Where you'll have assessors look at things just without putting a commercial hat on as to why, in terms of why they should be looking for ways to approve an application versus looking for ways to decline an application.
Mm.
So a lot of it really about choosing the right lender for a client is about understanding the client's profile, understanding what their goals are, and then trying to find basically the lenders that are going to make that experience easy for them in a sense. So
Yeah.
yeah, it's an interesting one, but a lot of it comes down to that. And look, every broker will have lenders that they kind of prefer to work with at different points in time, and a lot of that is driven not so much by rate, but it's driven by the lender's approach to lending.
Yeah, and
Um,
whilst we'd probably want to say that, we are nervous at the thought of, a computer processing our application and getting the whole computer says no response, as you point out, the alternative is a human on the other end who might have a different, approach or attitude towards, a certain borrower characteristics. So you're at the equal mercy of that as well.
and I think it very much is heading down that space too. I mean, if you look at some of the stuff that's going on right now in the wider market, so NAB has just bought a bank called 86400, who were a big player in the digital space, or a massive kind of disruptor in the digital space. NAB have now bought them out. So really that's going to change the NAB proposition, because that'll become their UBank sort of front end, if you will. And that's a fully digital end-to-end sort of bank with a broker channel attached to it. So I think you're going to find a lot of sort of disruption now in the market driven by technology. So it's going to be pretty interesting moving forward.
Yeah, for sure. Now, there's been a lot of talk in the last couple of years about this, so-called bank of mum and dad, the housing affordability, and particularly first homeowners, seeking the help of relatives to, act as guarantors for their borrowing. What are you seeing out there?
Yeah, so I suppose lending's a balance of two things, right? So it's really around, one is what's your borrowing capacity look like? And then the other one is how do you fund a purchase? So the guarantor piece really comes into it, comes into its own in terms of how you fund that purchase. Because if you have a 5% deposit, for argument's sake, and you can't get onto one of the schemes, you're either going to be paying a very, very large chunk of lender's mortgage insurance, or you use a guarantor to kind of get past that scenario. Now, in the guarantor space, the changes over the past few years, and this is all post Royal Commission around responsible lending, it's really made it harder, I guess, to have a guarantor in play, because the policies have very much tightened up around that, and guarantors now have to, for example, seek legal advice. With some banks, they have to be working. With some banks, The guarantors have to be able to justify why they're putting up certain properties if they're putting up their owner-occupied property as security. So really, it's a tighter space now than what it used to be. It used to be pretty fluid or pretty easy in a sense. Pre-Royal Commission, post-Royal Commission, that's a bit different, which again is not necessarily a bad thing because the focus is on, I guess, protecting the guarantor in many ways. So not necessarily a bad thing. But there are plenty of options out there in terms of people that are looking to, utilize the bank of mum and dad, as you call it. That definitely exists. And it's either, you can either do it via a guarantor approach or via like a cash gift. So it might, an injection of $20,000-$30,000 to pump up your deposit and put you into a position to purchase. So that you were definitely seeing a fair bit of that. There is definitely a much higher reliance on, I guess, because with house prices going up, you are starting to see challenges now in terms of how much people can borrow and what function that is of their income, which is the debt to income discussion, and then also really around, can we leverage, for example, the house of mum and dad to kind of get us into the market earlier than they'd otherwise be able to.
Yeah, and I guess in their favour is that, with rising prices, then, you'll be more quickly able to revalue the property and remove that guarantee potentially more quickly than you would have done in, with less growth in the market.
Yeah, and I think right now, look, I mean, to give you an example, I would have had a client who settled a year ago, and around evaluation was about 14 months after he settled, and the place had gone up 23% according to that valuation. So, there is definite movement in house prices that is interesting.
Yeah. So we're talking in lockdown, I don't know what we are, 6.0, 10.0, I don't know what it is. Day post an earthquake. I don't know what the world has in store for us tomorrow. Hopefully a win for the D's on Saturday. That's what I'll say. But, we've been in lockdown for a while, and, how's that impacting your clients? Because I'm imagining that, the time clock is ticking on their pre-approvals. So
one word, massively. So yeah, it puts pressure on them to buy. The ones who are probably hardest hit are not so much just your average Joe Blow pre-approval. It's really the ones who are on some of the schemes like the FHLDS scheme, because those schemes are
that's the first home loan deposit scheme.
Home loan deposit scheme, correct. So those schemes are limited with the numbers. So what happens is, you're in a queue, you sit in that queue for, you've got your number lasts for 3 months. And once your 3 months is up, if you can't get it extended, you lose your spot in the queue. So that's really where I guess lockdowns hurt a fair few of my clients. And I do have clients in that space. Generally speaking, yeah, absolutely. With not being able to inspect properties, investment, a little bit different, because I think you'll find a lot of people are willing to buy investment properties without looking at them. That's why you'll find, investors will buy properties interstate and stuff like that, right? Or in regional areas, for example, Ballarat is going gangbusters. But certainly in the owner-occupied space, there's a massive slowdown in that, because if you can't inspect, well, 9 out of 10 people are not going to buy a house to live in without inspecting it. And that's fair enough. So yeah, there's definitely a slowdown from that point of view. I think now that they've sort of slightly eased restrictions last weekend with respect to inspections, I've certainly seen a pickup in terms of activity for people who are actively looking and sort of going out there and trying to get through to look at properties that they're interested in, because the demand's definitely there. People are lined up ready to buy. It's just getting the supply there and being able to inspect. So yeah, investor side, not so much of an effect. Owner occupied side, massive effect with the lockdowns.
Great. And help me out here with this next question. How close to, I guess, reaching the top of their borrowing limits are people, or have they still got room to push prices up?
Right. So if I put so that's an interesting little hat to put on. So look, the information coming out from the banks and the regulators is those numbers are pushing up. They seem to think the numbers were higher a couple of years ago. And again, we're talking debt to income ratios now, right? What I guess I've seen is a lot of clients now who are pushing the top end of that. So really, we're talking, if I have a client that's 6 times debt to income, that's almost super conservative. So, most of my client bases now are pushing 7 and trying to push up above that. And this very much comes down to, I think, what levers the regulators are going to have to play with next year, because everyone said they don't want to touch rates.
Mm.
And if rates stay as low as they are, well, house prices will continue to go up. It's as simple as that.
Yeah.
So the other levers that they can play with is things like debt to income ratios.
Mhm.
So, and again, this is where you get into the complexity of lender policy, where there's a whole bunch of different policy around. If you're borrowing 90%, you have to have a 6 times debt to income. But if you're borrowing 80, we can push it up to 7. And if you're borrowing
Mhm.
60, we can push it up to this. If there's an investment property, we can do that. And this is really where I guess the broker comes into their own, in many ways, in terms of where the value add is, which is navigating that for the client, right? But I think debt to income is going to be a big challenge next year. So I have definitely seen that profile go up with my clients. And again, I think this is where possibly the numbers are being skewed a little bit in terms of how the market looks at it, because I think when they're talking about the growth in lending, they really look at, they're including refinances in the numbers, I think. And really, you've got to strip it out to say, what does it look like in the purchase market? What does it look like for first home buyers? What are the debt to income ratios that people are going to over there? And I've got probably 3 first home buyers right now who have all pushed up at 7 times debt to income. So, which is a stretch and it's a challenge. And they can afford it. They've been living at home with mum and dad and saving like crazy through COVID. These people have done a fantastic job of doing that. How they're kind of able to cope with it now once they move into their own property and they have to pay rates and utilities and all these kinds of things, time will tell. So, and look, you'd expect their salaries to grow, quicker than someone that's in their 40s who gets normal salary growth. Someone in their 20s will, invariably change jobs or, jump income scales and things like that. So there's coping mechanisms like that, but it's an interesting one. It's definitely a challenge. It's definitely a challenge moving forward. And I think you'll find the regulator acting on that from next year.
Certainly starting to, make some noise and say, well, if we're not raising rates, well, what are we doing, or what can we?
Well, I think they've made it pretty clear. I think the RBA's made it pretty clear that they're not going to raise rates, which is an interesting approach. So, and look, even when you're talking about rates, we've seen some banks in literally the last couple of weeks who have dropped their variable rates, which I found really fascinating. Because fixed rates are already down at record lows. You're seeing fixed rates down around the 2% mark. You're now starting to see variable rates come down closer to 2% as well, which is interesting. I would have expected it to be going the other way, but clearly it's not. So something's sort of happening in the system there.
You've touched on some of the value of using the services of a mortgage broker. So, obviously, it's really overwhelming, and it doesn't surprise me that, just to under half of borrowers actually, choose to go direct to a lender. And I suspect that's a bit of overwhelm and just wanting to keep the decision fairly simple and to one where they're not having to compare products that are actually really difficult to compare. So what's a great client story that you can share with us that really showcases the value that that your profession brings?
I'll give you a couple of examples. So one is, I guess one is really about the long-term benefit of working with a broker. So, it's not a broker, well, a good broker is not just about going out there and getting your first home loan and then forgetting about you. A good broker will keep in touch with you, whether probably annually or at least biannually, complete reviews on your home loan and stuff like that. And that could be as simple as calling up the bank on your behalf or emailing the bank on your behalf every year and saying, hey, give us a better rate. Can we get a better rate? Now, I'll give you a really simple example of that. One of my bigger clients, and I do annual reviews for most of my clients if their rates are variable. One of my bigger clients, I literally just sent an email a few days ago to the bank, and came back about 4 days later and said, yep, we're happy to reduce his rates. And I added up the numbers. Now, this client's got a few properties. worked out at, I think, somewhere around $12,000 a year in interest that he was saving. And that was off the back of one email. Now, if that client had have gone direct to the bank, which is fine, if they went through the branch channel, I guarantee you they would never have heard from the bank again, unless they contacted the bank proactively and said, hey, what can you do about my loan? And they would have to go out there then and find comparative loans to compare like for like and things like that, and put that up to their lender to say, can you review our rate? So we sort of do all that on behalf of our clients, and really it's about finding, savings potentially for the client. So when I'm refinancing a client, for example, it's all about how much can you save, essentially. And I've seen clients who've come to me who went direct to their bank, for example, and they're paying in this environment, 4.5% because they've never looked at their home loan. And I've said, well, okay, well, we can get you down to 2.5%, and that's going to save you about $24,000 a year in interest. Now, all that would have taken is the broker essentially just contacting the client each year and just touching base and saying, hey, what's your rate? Let's do a bit of a review for you here. So that's one example, right? That's really about, I guess, the ongoing benefit of having that relationship with a client. And for me, my approach to it has always been, I'll look at it in terms of, I would hope to work with my client base for 20, 30 years, for as long as I do the job, right? Keep them happy and keep doing it that way. So that's one example, right? Another example is, most clients, I guess, historically have been of the opinion that because they bank with a certain bank, if they go in there, it's going to be easy for them. Their money or their savings are held at that bank, and therefore the bank will lend them the money, right?
Look after them.
So I think that's a bit of a misnomer in some ways. So I found a lot. I mean, we pick up a lot of clients where they've gone into their bank has declined them for whatever reason, and they've then come to a broker and said, hey, can you help us? We've been declined at our bank. And I think there's a lot of this, the broker adds a certain amount of expertise, which, and again, I can't speak for every broker out there. I can kind of speak for how I operate. But the broker brings a certain thing to the party, which I don't necessarily know that, someone at a branch will do. And I'm not trying to be disparaging in any way, right? But with me, I get all my clients to send me links to the properties they're looking at before they purchase it. Mainly because I might pick up on something that they haven't seen. Banks have policies around minimum size. They have policies around types of title, type of property. There's a million different policies out there and pitfalls that you have to navigate. So before you go and make an offer on a property or bid at an auction, I would always say to my client, guys, just send me the property so I can have a look at it. Maybe I'll pick something up. I had one where I just looked at the photos and I picked up the fact that it looked like it didn't have pool fencing, which potentially is going to be an issue. So I said to the client, okay, go away and just address this with the agent, just have a look and see what you can come back with. So a lot of it is about that, right? A lot of it really is about kind of, with first home buyers, very much about holding their hand, explaining to them the difference between a fixed and a variable rate. And there are big differences. It's really about customizing solutions for people that work for their circumstances. And I don't necessarily know that you get that through either the proprietary channel of a bank or that kind of service, or through a digital sort of lender as well. So
yeah, 100%. What great examples. And that I guess misplaced assumption maybe that a bank will repay your loyalty by looking after you. I had a fascinating conversation with a mum at school, about her bank and who she was with, and how great rates are at the moment. And I said, oh, when was the last time you reviewed your mortgage? She goes, oh, I just have it with my bank, and I'm happy. And I said, are you happy? Because they've moved a lot. And I said, what if you could have an extra 20 grand in your pocket? And she was like, oh, yeah, I suppose. But, it's kind of the if it ain't broke, don't fix it mindset. But, dangle the cash in front of someone's face and if they could get a better deal, and just knowing we're all so busy. We've got life admin is coming out of our ears, right? And I think it's just that one extra thing. So if you know that there's someone who's an expert in that field, who's got your back and is reviewing things on a regular basis, when you've got other things to take care of, then I think that's a wonderful peace of mind. And I certainly, for one, always recommend buyers to talk to a mortgage broker rather than go direct to a lender, just for that very reason, of just understanding all the pros and cons and some of the hidden benefits and hidden nasties that can sit within a product, that only the experts are really able to pick up, as you say.
I can give you another example too, where, I had a client who didn't realize that even fixed, they didn't know and explain to them what the catch was at fixed rates, and they decided to sell their property and had a $25,000 break cost to pay. Now, if that was my client and I'm speaking to them and I'm sort of saying, well, what are your plans over the next few years? And they say, oh, Dave, we're going to sell in 9 months. I'm going to say, well, whatever the heck you do not fix, right? Because you may have this giant break cost coming up. So it's things like that. It's very much about just having someone that pays a lot more attention to you and to your needs and gets an understanding of that. And brokers are under this thing called the best interest duty now, which basically, I guess, legally obliges us to act in our client's best interest. And, the idea is about choice. So, we've got access to, in my case, I'd have 25 different lenders that I work with directly. And it's all about kind of working out how best to fit a client somewhere.
Yeah, that's right. And not only the best interest, but complete transparency in terms of, the commissions that you receive.
Oh, absolutely.
Doing business with them. So that's been a really important consumer protection that's come in.
Absolutely. Yeah. So it's an interesting gig.
Amazing. Well, I've learned a bunch, and I'm sure those who are tuning in have as well. Dave, thank you so much for joining us and shedding some light on the very complex and fascinating world of lending.
Thank you.
We'll talk to you soon and enjoy your public holiday tomorrow. Thanks for joining.
Will do. See you, Narelle.